So we often see or hear about this comparison between the retail investor versus the institutional investor. And we always hear that the institutional investor is the savvy investor, right? They're the investors that are getting out when all the retail investors are just figuring things out and getting into the market. They're escaping or selling a stock when all the retail investors are seeing the stock all over the media and perhaps buying. So I thought first we would define what the retail investor is versus what an institutional investor. And probably the simplest way to do that is a retail investor is the average Joe walking the street, the person who invests their money into their own RSPs, does their own investing, trying to get ahead, trying to improve or grow their wealth so that they can live a great retirement or provide provide the funds needed for their children to go to university or college or really whatever their goals may be. So the retail investor is the average person who invests for themselves. Institutional investors, the best way to, I guess, to define them is an entity or a person that invests for somebody else. Hedge funds, mutual funds, savvy traders, investment advisors. These are individuals that are called usually savvy investors. These are the people or institutions that invest for others. And it's interesting because coming into this year, we all look at these institutional investors as knowing what they're doing, always seem to have the right answers, getting in and getting out before the retail investor, even catches on to what's happening. But have the institutional investors gotten it right this year? Strangely enough, the answer is no. Coming into this year, institutional investors or the savvy or the smart money was betting on things such as oil. I remember start of January, all I heard about is how the smart money was buying oil companies, that oil was going to go back up to $90 to $100 a barrel based on a number of factors, geopolitics, Russia, Ukraine, China, et cetera, et cetera. Well, that didn't play out. And in fact, what did play out was retail investors and a lot of money going into other sectors of the market, the sectors that were most beaten up last year, in which the institutional investors didn't even want to touch, like technology. And I think that's why tech has done so well this year, because it caught a lot of people by surprise. And that to me is something to note, that not always do the institutional investors have the right answers or all the answers. And so what can retail investors do to compete with the institutional people? Well, number one, I think a good strategy is to be a contrarian, to buy when those are not buying, to be greedy when those are fearful, as Berkshire Hathaway or Warren Buffett says. You want to get in when those are exiting, and you want to get out when those are getting in, because that's what the savvy investors do. That's what the institutional investors do. And that's what I think all investors should do if you're looking for growth. The other thing I think retail investors can do is get some help. They can get some help by hiring an investment advisor. I'm an investment advisor, senior investment advisor, the Allen Small Financial Group. As I said, I've been investing money or helping people invest their money for over 25 years. And I have a chart here which shows how well individual investors do when they take on the help or some of my financial advice. And this chart is very interesting, and you can see right away, very easy to see the differences. So on the far left, you have the difference. This is from 2014 to 2018. And you can see if someone does not have an investment advisor, they work alone, they decide what their portfolio looks like on their own, you can see how much they grew in those 4 years, about 42.6, for $42,600. And you can see here, 41.8 if you had, an FA to start, but fired your FA or no longer used a financial advisor at the end. You can see how much your portfolio grew there, or portfolios of people grew there. Then you start to get to, okay, well, what if you didn't have a financial advisor at the start and you took on a financial advisor later on in those 4 years? Well, you could see you had double the growth of the other two. And lastly, what happens if you had an investment advisor, financial advisor throughout the whole 4 years? Well, you showed the most growth by far. So this clearly shows that if you're looking for help, if you're looking for advice, if you're looking to compete with the savvy investors, compete with the institutional investors, Well, maybe you just need to take on a savvy investment advisor to help you make those difficult decisions. Because one of the things that investment advisors can do for you is take the emotion out of investing. A lot of us are very emotional when it comes to our money, our savings, our life savings, growing our wealth. And so sometimes you get married to a stock. I know many people, for example, are married to Apple. And I can tell you, in my opinion, Apple is a name today that I think is fairly valued. Will it go up over time? Perhaps, but I think it's fairly valued. And I think there are better names to own than, say, than a name like Apple. So investment advisors can help. And I think they can help the retail investor compete or grow your portfolio over time to take on or compete with the savvy investors or the institutional investors over the years to come.